is a CFD. A CFD is an acronym for Contract for Difference. The contract for difference is made between an investor and broker. Just like stocks, it is traded on an exchange. Except for one thing. Trading a CFD on an asset, you don't own this asset at all. Let's take a closer look. Assume you're an investor. XYZ is a company that produces medical equipment. You have noticed that the company has been thriving recently. Consequently, you strongly believe that XYZ shares will go up in price. How can you profit from this price movement? Of course, you can buy a bunch of XYZ shares and wait till they skyrocket in value. But it will be a sad story if the rise in price is minimal. Is it really worth it? Another option is to buy a CFD on this share and take a long position. If the price goes up as you predicted, you receive the difference between the opening and closing prices. The higher the price goes, the more money you will receive. But what if you are convinced that XYZ shares will soon fail and their price will crash? Well, in this case, you can just sell CFDs on XYZ shares and go short. What happens next? Exactly. The lower the price will go, the larger your profit will be. One of the biggest, brightest, and most important advantages of a CFD is that you can buy, go long, or sell, go short, on margin. This is when the magic begins. In other words, if a margin is 1 to 10, you have to pay just 10% of the share value. Suppose you plan on buying 200 XYZ shares with a total worth of $20,000. Trading CFDs on these shares, you can purchase them with just $2,000. But where do you get the rest of the money? Brokers. They make your deal a reality. In the end, you own 200 XYZ shares with a total worth of $20,000 thanks to leverage. Everything is great, but you know what? There is still one detail to bear in mind. If you hold a CFD position overnight, you are charged with an overnight fee. Don't forget about that. A CFD is a good thing. It allows you to access global markets sitting in one place. It is much cheaper than trading real assets. It helps earn real money on price movements, access to blue-chip shares like Apple, Google, Amazon, top trading commodities like gold, silver and natural gas, major world indices like Nasdaq 100, S&P 500 and FTSE 100, and many more. You may think that things aren't always rainbows and butterflies. What happens if your trade moves against you? Well, you lose the difference in price times size. But no matter how great are the price changes, you cannot lose more than you invested.